The following is the second segment on damages. Okay, so what are the components of damages likely to be? Well, again, each case is going to be unique. So in some cases, you're going to be calculating or estimating lost profits. In other cases, it'll be lost value. It could be lost cash flows. It could be lost revenue. It could be extra cost or incremental cost. It really depends upon the case. It depends upon the nature of the damages, and it also, to some extent, depends upon what type of accounting data is available that is reliable that you can get your hands on. So the issues that you want to consider when you're calculating damages are what is the appropriate methods. And the next segment will go over the type of methods you can utilize. The damage period is critical. You've got to identify which period did the damages occur. Some damages are actually infinite. They would go from now to the end of time. A company that's put out of business will be damaged forever. But for a lot of cases, the damage period is from X to X, from the beginning of the damages until we can get the problem fixed. The definition of profits. Sometimes there are contractual aspects to how profit was defined. In other cases, we're going to use generally accepted accounting principles. But we need to identify what is the lost profits. If there's growth involved in the company, in the activity, in the revenues, we need to identify what is a reasonable growth rate and incorporate that into our calculation of damages. And then finally, the discount rate. We have to make sure that everything is stated in current period dollars. So anything that's related to the future earnings, future revenues, future profits, future costs, we need to discount those back to today's dollars. So the calculation approaches for damages, the methodologies. We can look at out-of-pocket costs. This is the difference between an actual value received and what it could have been or should have been, in what was actually conveyed to the plaintiff. The plaintiff can recover nothing beyond his or her investment in some cases. That's in New York and California. And then there's no opportunity costs. So in some cases, we simply look at the out-of-pocket loss, and we don't consider the fact that these damages could go into the future or might be infinite. There's also the theory of the benefit of the bargain, which is an expectations-based remedy, and that's what you get in the majority of the states. The damages here is not only any money that was invested, but also any other expenses such as increased costs, lost profits, decrease in the value of the investment. So there we take a more holistic approach to damages, whereas in New York and California above, where we looked at the out-of-pocket losses, those are going to be stipulated by state law. And so again, there's a variety of considerations we have to give, and normally you're not going to be on your own making these determinations. The lawyers help set the scope for you. And then, of course, you have to be very clear what any scope limitations were in your report in order to make your report readable and understandable in the context. Related to lost profit methods, you got the before and after method. So this is an invigilation approach. We talked about invigilation in either Chapter 1 or Chapter 8 of your book, and we covered it in Accounting 581, the prior course. But you basically take sales or sales growth before the act, you compare that to comparable figures after the act, and then basically it assumes that you'll have static trends in business and that you can compare those static trends to a before and after period. There's also a yardstick or a benchmark method where you compare the sales or the growth in sales of this company to other benchmarks, other companies in the industry or industry averages, that sort of thing. Generally speaking, the before and after method is more common than the benchmark, although I have seen situations where a benchmark is used. Then there's also the but-for approach, and basically you take the difference in estimated profit. So this is what we thought we were going to do. This was our budget. But for the interference of this individual, the defendant, here's what happened to our profits, and we look at the difference of that. So we compare the difference between an estimate or a projection or a budget and what actually occurred. We're actually going to use a variation of the but-for method in the Alexandria Natural Resources case we're going to look at in some of our modules. So this really looks at the opportunity for businesses to change over time and to incorporate new diversity to the business practices. You have to do some modeling or statistics in order to make this happen. The direct method is an agreement among the attorneys or the plaintiff and the defendant. Let's calculate the damage in the following manner. And if we can come up with a methodology agreement, then the forensic accountant, the expert, the the damages person, consultant, then just calculates based upon an agreed upon methodology, and of course that has to be disclosed in the report. And then you could use any combination of the above methods depending upon which ones make sense for your particular case.